Thank you for joining us today and what seems to be a very popular topic today. I'm Corey Vanderpoel, along with Hanna, both managing directors at Taureau Group. It's important to understand when we're talking about the M&A market and current dynamics that a lot of what we see in the lower middle market is actually based on personal timing and objectives. But value is also of the utmost importance. So we're going to talk today about a number of different impacts that COVID has had on both timing and valuation. First, for an overview on Taureau Group. Taureau Group is a boutique investment banking firm focused on transactions between $10 and $150 million. Collectively, principals at Taureau Group have over 100 years of M&A experience and backgrounds coming from bulge bracket investment banking, senior operations, business ownership, and commercial lending. The firm has transacted hundreds of deals worth billions of dollars in aggregate transaction value. We pride ourselves on really maximizing value for our sell-side clients, which makes up about 70% of our practice. The remainder is made up of acquisitions and debt placement projects. And while many of our clients are in the North Midwest, we're a global firm. So the other side of the deal could be anywhere in the world.
So let's start looking at, we're here to talk about whether COVID has destroyed this seller's market that you've been hearing about the last 10 years. And we'll start by looking at a general business outlook. First of all, CEO confidence is climbing. Chief Executive CEO Briefing ran their monthly survey recently and found that CEO confidence is approximately where it was in January of this year. In addition, the stock market is down less than 5% from the pre-crisis levels. And we all lived through the up and downs of this stock market since COVID started in March. Hopefully you all have great advisors like our sponsors, the Riverwood Wealth Management Group at Morgan Stanley and Jeff Krause. We went through a roller coaster, but we seem to be back. So far, the S&P 500 companies that have reported earnings for Q2 are reporting higher than expected earnings, about 74%. Although a caveat to that, expectations were extremely low for Q2. Most of what we're seeing in the stock market is that people believe that a vaccine is not if, it's a when situation. So there's a lot of positive reaction and stocks are doing well. Thirdly, COVID-19 has impacted everyone differently. So there's definite winners such as e-commerce, logistics, telecom, and tech. And there's definite losers like the airlines, the cruise lines, hospitality, energy, and financials. Now, a seller's market is made out of two forces. Number one, you've got to have a number of businesses to sell that is lower than the number of buyers you have available. Now we've seen the baby boomers come to market, and they've been coming to market at a much slower rate than anticipated. On top of that, we've got a lot of capital available. So we want to look at what has COVID done to capital availability and bank lending. First of all, and as we've talked about the seller's market, and as you've heard, there is a lot of dry powder. So private equity is still raising funds. They have a lot of resources, and dry powder is still estimated to be around $740 billion, which when you use leverage to purchase companies with that, they've got approximately $4 trillion of spending power.
And this fundraising is happening even through COVID. For example, Mason Wells just raised a $725 million fund closing April 2020.
Right. So we've seen private equity become active through COVID, taking minority stakes, doing mezz lending. They've gotten very creative trying to continue to get their money out working for them. Secondly, we look at banks. Now, banks have prepared themselves and they've braced for the impact. Some of the largest banks in the U.S. have made reserves in Q1 of 25 billion and in Q2 of 35 billion in anticipation of losses. So they're looking ahead, they've made the reserves, and so they're prepared. In addition, what we're seeing is that the bank regulations, the bank requirements, they're tightening. And a lot of deals that were in process when COVID hit, actually they're being either pulled back or they're being reassessed. And from an M&A perspective, as you're doing deals, what this means is you're going to need to take an extra step, and you're going to have to make sure that you're going out to a large number of banks and that you're finding a variety of financing resources, because like industries, the banks are all reacting a little bit differently. And understand that you are going to need more time to put your lending in place.
And this takes much more time from your M&A advisor to actually, before going through a process or during a process, reach out to those lending institutions. It also brings additional sub-debt and mezzanine lending into the lower middle market.
And finally, liquidity from corporate buyers. So we've talked about the private equity buyers. We've talked about the bank lending, which is going to affect both private equity and corporate. But then we need to look at the corporate buyers. And that liquidity could be challenged. Corporate debt levels are 30 to 40% higher on average now than in the 2008-2009 recession. That's going to make getting additional leverage even more difficult. Companies, certain corporate management teams and board of directors have taken a conservative position, and they're protecting company liquidity. So we've seen some corporate buyers become more reserved, become more careful and conservative. So that could also affect our sellers market.
So COVID-19 has obviously had a significant impact on the M&A market, causing certain deals to be put on hold while other deals are actually getting done. So the deals that are getting done include those that are strategically motivated, and these are generally buyers that are looking beyond the cash flow performance of a business and considering things like geographic capability or customer expansion. Secondly, industries not affected or positively impacted by COVID are also getting done. And while underlying revenue and profit trends are really unaffected, we're seeing no change in the deal interest and the values in those types of deals, especially when there's no underlying financing required to the deals. And lastly, for deals getting done, we're seeing distressed situations, along with a rise in private equity minority stakes. So these are generally sellers that require liquidity and support through these unique times, and the deals are getting done with some kind of customized solutions.
Right. And the advent of distressed situations is really, this is the first time we've seen this in over a decade, where we're seeing more and more companies that have some kind of a financial constraint coming to market to be sold in order to satisfy maybe some of their bank debt or some of their broken covenants.
Next, for the deals that are getting done, we're seeing industries that were negatively impacted by COVID that they really had to take pause to understand, do they want to move forward with a process or put it on hold? And these are commonly put on hold until really the leading indicators show positive trends, which we're starting to see right now. Secondly, companies held by patient money, private equity groups. Institutional money can afford to be a bit more patient. They don't have the timing objectives of a personal situation. And lastly, those companies that have an unclear path to recovery, these deals often have conflicting views between the buyer and seller of where the company is going, and no real supporting evidence of either way. So it's difficult for the buyer and seller to come together in terms of value and terms. So we're seeing those deals more and more challenged. So ultimately, most people considering a transaction are asking, when is the right time? And overall, M&A activity has slowed dramatically since March of this year, but we are expecting waves of sellers coming back to the market really as follows. First, we're already starting to see, as I mentioned on the previous slide, distressed companies, recapitalizations, including minority recapitalizations, and those companies that are not impacted or affected by COVID-19, those are already happening. We closed a deal just last week or 2 weeks ago now, and have a few other clients in this category, and we're pushing all of those to close over the next few months. We're also starting to see certain corporations that are really focused on their core operations, and liquidity for them is becoming more and more of a topic. So they're considering divesting or carving out certain areas of the business. So we're starting to see more of those and expecting those will continue. Thirdly on the slide, closely held businesses who have recovered or have a clear path to recovery. And this likely includes most of the listeners on this call today. We have a number of clients in this category, and they're looking to come to market as soon as the COVID impact lessens. Some will be in early August based on their continuation of improvement in the business, and others are going to require another month or two of review of the financials to make sure that everything seems to be moving in a positive direction. Fourth on the list is when we start to see performance continue to return to normal, we're going to see a pickup in private equity sales and the volume of those types of deals. And lastly, we're also seeing those business owners that are most focused on the future concerns around the outlook for taxes or any presidential election or administration change. And they just want out of the business. So we're seeing a few of those companies as well.
So to wrap this up, has COVID destroyed the seller's market? Well, the answer to that is it depends, and probably just temporarily. So it depends. It depends on your industry. It depends on the risk associated with your business and your industry. Are you pandemic resistant? Are you recession resistant? Are you a strategic play for someone, or is a company you're buying strategic in nature while the financial parameters are not as important? You know, do you have tax motivations in order to sell or buy? One thing is that buyers, what we're expecting and what we're seeing is that buyers are not going to automatically assume that pre-COVID equals post-COVID. And you've probably read a lot and seen a lot about EBITDA, earnings before, interest, taxes, depreciation, and coronavirus. But they're not going to automatically assume and accept those add backs until they know that what your post-COVID is going to look like. So buyers are going to be assessing, and they're going to want to know what the new normal is. And once there's a path to what the new normal is and what you think the new normal is, and remember, depending on your industry, your new normal may be better than your pre-COVID normal. But what we anticipate is there's still plenty of capital. There's still plenty of lending, and the banks, I think they've been very responsible. They've reserved. They're going to be careful right now, but then they're going to be back to business as usual and out looking to loan money. So we believe that the seller's market is going to come back relatively quickly as soon as we can put to rest a little of the uncertainty that's out there right now.
Great comments. And I would just add one thing, that in this market, what we're seeing is a real value to considering broad options. And that means when some businesses sell to a company that proactively approaches them. But in this market, you don't know if that company is someone that can get comfortable with the current environment or someone that is very uncomfortable and will be difficult to get a deal done with at maximum value. So the breadth of going to a number of potential buyers, also the breadth of including a number of different lenders, really adds a lot of value to the terms and the value that you get when selling a business.
So with that, we'd be happy to take any questions. I believe what you'll need to do is unmute your button at the bottom left-hand corner. And you can share your video if you'd like, but we're happy to take any questions you have.
Don't be shy.
We could also go to the chat room. Let's see.
Oh,
Okay, someone said great jacket. I thought they were talking about me, but they were talking about the senior Maglio with the tomato jacket. Oh.
And we can send the presentation.
Thank you, Linda. Thank you. Any questions?
It's a unique time out there right now. So the answer, it depends, has always been a staple when people ask about the value of their business. But now more than ever, it really does depend. So make sure you get the appropriate advice, talk to your advisors, whether it's tax, whether it's legal, whether it's investment banking, and make sure that that you get that feedback.
Yeah. And there is a lot of activity. I mean, people talk about the M&A market being shut down. It really is not shut down. We have several active buy sides. In fact, June 30th, we closed an active buy side. It was very strategic, and it was in North Dakota. But we continued with the sale, and we closed on it because, number one, COVID had no effect on this company. And it was a very strategic buy for our client. So we're still continuing to do buy-side acquisitions. We're still continuing to market. It just depends on the industry on whether you're going to market today or whether we're going to hold it to, maybe Q4.
We just got a question in regarding how will revenue decline be factored into deal pricing going forward. And again, we've used the term a lot, but it depends. And it really does depend on whether it was truly COVID related. And there's a number of questions that we can go into to address whether it was COVID related. But this is the exact definition of an extraordinary and non-recurring event going through this. So in theory, any kind of shortfall or impacts to the financial statements could be made up as long as the run rate and profitability after COVID or upon the resurgence of your business can return back to normal. So that takes a little bit more discussion and more consideration and more analysis to prove that out to buyers. But we are expecting that to really continue forward to not have a significant impact on value.
Right. And remember, adding on to that, remember that a good deal process takes 7 to 9 months. So even if you're not back to your pre-COVID revenue, if we can show a path to that prior to really LOIs being due, prior to that negotiation, then there should not be an impact. So there's no need to wait until your revenues are 100% back to start your process, because you're adding 7 to 9 months onto that. You can actually go into your process, and we've got several companies right now where we're doing the marketing portion, and then as soon as there's a clear path, then we'll start the marketing. So I think we have another question about how this is affecting deal structure. And I guess that depends if we're on the buy side or sell side. But no, if you're trying to get a deal done prior to COVID effects being completely mitigated, and you want to get the deal done because it's strategic, but you want to pay a fair price, and there's some question as to whether you're going to attain your pre-COVID levels, that's where we have seen earnouts used. And so, to be fair to buyer and seller, if you attain this pre-COVID level of revenue and profitability, then you will get the full purchase price. If you don't, then I haven't paid the full purchase price for on assets that's not performing at the level that we thought.
When we went through the slide and showed the 3 types of deals that were not getting done, one of the deals not getting done were those that had kind of an unclear path back to the new normal. And for those deals or those companies that don't have a real exact path back to pre-COVID levels, those are the deals that we're seeing more of an earnout or some contingent portion. That being said, most of the other deals out there that have a good understanding of their revenue trends, we are not seeing any additional earnouts or seller notes or anything like that. The seller notes come into play because of the bank financing. And again, it comes down to the breadth of finding the right lender that can support your deal and potentially bringing in mezzanine debt to bridge that gap in the debt amount. And then we have another question. Are you seeing competitive synergy deals between competitors trying to consolidate? Well, this is always out there as a potential. I'm just personally not seeing a lot of that right now. And the reason we're probably not seeing a lot of that right now is if competitors are generally in the same industry, and if the industry is not doing well, they don't want to expand in that same industry at this point in time. And on the other hand, if they're doing really well, then those companies that are also doing well in the industry aren't necessarily looking to take any discount to valuation. So we're really not seeing any impact on that. The one thing I will say is that certain competitors that are well financed and capitalized, they can, and they have a real progressive growth structure, they can potentially approach those other parties that are in their industry, especially if a fragmented industry, to support them through these times and pick them up. But that would have to be really appropriate for that seller to sell during this time and need the support of a larger company.
Yeah. And I would have to say our buy-side acquisitions that we're doing right now, they both clients are actively looking for companies, for people who look like them, people in their industry, and they're trying to pick up geography, they're trying to pick up new customers, and in one case they're trying to pick up new service lines. So just by the nature of what we're looking for, we are acquiring competitors. But the intent is not to get rid of competitors. It's rather, the intent is to buy people who look like us in different geographies.
As Ann mentioned before, there's really no two answers that are going to be exactly the same depending on the situations of various underlying companies. So it is really important to start a process, make sure you take into account all avenues as far as where or who is the appropriate buyer type, whether it's private equity group, corporation, strategic private equity group, or a family office. And now is a great time to start talking about that and actually getting a process going. Ann mentioned before, it can take 2 to 3 months before you go to market. And what we're doing with our clients that we started with throughout the COVID period is we're really assisting them to get a handle on their performance and their return back to normal profitability, and how they're meeting or exceeding or under their current budget, how that's going to impact them and the timing of such when we go to market. But overall, we're seeing the M&A market continue in the lower middle market.
And I think we have time for one more question. Let's see. What would be the best investment banker to hire? Why, I think that would be Taureau Group. What do you think, Corey?
Yeah, absolutely. Any other questions that we can address for you today?
Okay, well, thank you all for being here. Thank you all for listening and tuning in. And I think we had a great presentation by BizTimes and all the sponsors. Tim Michaels and Greg Marcus were really fantastic presenters, as well as the other breakout session. And appreciate everyone logging on this morning.
Thank you very much. Have a great day.